Hi everyone. Throughout the last 10 years, we've seen historically low home interest rates and have seen rates well under 4% and even under 3% in some cases. If you've purchased or refinanced a home within the last 5 years, you've likely been spoiled with a historically low interest rate. In other words, real cheap money. However, all good things must come to an end at some point. At least, that is for the time being. On March 17th, the Federal Reserve approved a 0.25 rate hike, the first increase since December 2018, which on paper doesn't seem too bad until you start unpeeling the layers to further examine what this may mean for you. In today's video, I'm gonna explain why the Federal Reserve increased rates, how inflation impacted the decision, how the rate impacts the real estate market, what I think will happen, and if we're in a bubble or not. Now, if you like videos like these, I truly appreciate your support by hitting the like button and considering becoming a subscriber. As a thank you, I will give you 100 grand, no strings attached. Thank you for your support. I think it's important to start with why the Federal Reserve is even increasing their interest rates. On January 11th, Federal Reserve Chair Jerome Powell announced that the Federal Reserve plans to raise its key interest rate this year, as in his words, the economy no longer needs an accommodative stance. Furthermore, the Federal Reserve will continue to raise rates and project to raise rates 6 additional times in 2022 alone. In case you're wondering, why does this even matter? Let me explain. Think of the Federal Reserve as a gardener who can increase or decrease the amount of water and sun for their plants to grow or to slow down. On the other hand, lower rates are good because they encourage more borrowing for you and businesses to invest and possibly create jobs to help kickstart the economy. On the other hand, once the gears are in motion and the growth begins to accelerate too quickly, i.e. inflation, they try to hit the brakes by increasing rates to discourage borrowing. This includes bank-to-bank lending, which we call the federal fund rate. It determines the interest rate banks charge each other. See, banks need to have a specific amount of capital to lend because, well, the feds say so. If they don't have enough, they must borrow from other banks using the federal fund rate. All of this is done by the Federal Reserve in order to combat inflation. We're facing the highest rate of inflation this century, currently at 7.5%. There are numerous reasons why this is impacting us, but let's talk about the most obvious, which was caused due to the pandemic shutdown. The Federal Reserve typically likes to keep inflation around the 2% mark to keep up with the production cost, demand, and fiscal policy. It also encourages spending and investing so we don't simply hoard money in the bank. They want the economy to grow, so it's almost like people are penalized and lose money if you don't invest it. You may be wondering,
how am I losing money if I don't spend it? This is a scam. Lies, lies, lies.
Let's say, for example, in 2021, I had $100 to invest, and instead of keeping that money under my pillow, I decided to invest that money into a savings account. Not only would my money have only grown a few pennies, but today it would only buy 95.5% of what it could have purchased back in 2021. In other words, my bank account may say $100, but my spending power is really only about $95. On the other hand, if I would have invested that money into an index fund encompassing the S&P 500, you would have made money. With wages staggered and not keeping up with inflation, the Federal Reserve decided to step in, hoping to curb inflation. These higher rates are expected to lower demand, and reduced demand lowers inflation. But surely, this scorching hot real estate market can handle this type of pushback, right? Well, it was something talked about for months. We're just starting to see the side effects of the rising interest rates. Take, for example, fixed interest rates this same time last year. Interest rates stood around 3.18%, and as of March 31st, they stand at 4.67%. That's nearly a change of 1.5%. In other words, if you had a $300,000 mortgage at the lower rate, your monthly payment would have been $1,294, compared to the higher rate we see today, making payments of $1,551, minus taxes and insurance, of course. This means the potential homebuyers today could be paying $257 more than they would have paid just 1 year ago.
We had a good run.
The challenge now is that we still have low housing supply and high demand, with many prospective homebuyers being outbid and outpriced. Not to mention that the housing market historically heats up from April to September as kids are out of school, the weather is nicer, and let's face it, nobody wants to move when there's not much sunlight or the weather is cold. With the increase in rates, it's inevitable that some first-time homebuyers will be priced out or will continue to be outbid by higher qualified buyers. Just last week, one of my tenants reached out asking if he could go month to month with his lease this summer, as him and his girlfriend were having a hard time finding a home they would be able to afford. They faced what many Americans are faced with, an extremely competitive market where they're competing with in-state and out-of-state buyers, private investors, and corporate companies, along with the added challenge of low inventories and increasingly higher interest rates. Personally, I feel that 2021 proved to be the perfect storm for both home buyers and sellers. Sellers had numerous buyers to pick from, and buyers didn't have to feel bad having a higher mortgage amount because their interest rate was so low that they would have still been able to have a monthly payment to fit their budget. 2022 is proving to have a similar extreme effect, except this time it's not working in favor of home buyers. This time, it's priced out home buyers, prolonging their time as renters or keeping them in their current home. I believe rates will increase over the 5% mark within the next 30 to 60 days, with the possibility of reaching the 6% mark before hitting its peak. I also believe that some prospective homebuyers will temporarily pause their search, but due to the real estate busy season mentioned from now until September, I just don't see the market completely slowing down. In fact, I anticipate home prices will continue to rise simply due to the strong demand. Maybe this means there's more competition for starter single-family homes priced $250,000 and below, and a little less competition with higher-priced single-family homes. Of course, the price tag will vary depending on the home, size, condition, and location of the home. Ultimately, I feel that regardless of where interest rates are, you should buy when your finances are ready, not when the market says you should. You should have a certain monthly payment in mind, while also knowing that there may be a possibility to refinance in the near future if rates fall. I would also anticipate that by year's end, we'll still be in a seller's market, just due to the shortage of inventory and lack of non-luxury new builds. But of course, I can't help but bring this up, since there are always distant whispers of a bubble. While I don't feel there's a housing bubble, I do feel there will be a tipping point where buyers will no longer pay a premium to own a piece of real estate, and we won't necessarily continue to see home prices increase in the double digits. I envision we'll see modest home growth between 5 to 9%. Since the 2000s housing bubble, lending standards have also become more strict. Credit requirements are now higher, with lenders now only being able to approve buyers who can actually afford a loan. During the 2000s housing bubble, many unqualified buyers were provided home loans they simply couldn't afford. Lastly, while rates will continue to increase, the shortage in supply, increased demand, and increased rental prices will continue to keep prospective homebuyers ready for their opportunity to purchase a home. Now, if you've made it this far, you'll likely enjoy this video right here. I hope you enjoyed the information and the 100 grand. Thank you so much for watching. Take care.